being a person in a foreign country or even a foreign town or foreign city or foreign state gives you perspective because you're the observer, right? You can look at other people, you can see things that they may not see. And so, with all my travels around the world, I learned a lot about humans and human behavior because I was the outside person observing how people behaved. And it was hard for me to see that when it was me in my country. You can't observe yourself. So, one thing I noticed too is if you have kids, you get introduced to what it's like to be human and how we get created and how we create our dysfunctions too. And one of the things that I know for sure humans don't like and absolutely kids do not like is waiting for things, waiting for presents, waiting for Christmas, waiting for fill in the blank. They hate waiting and humans hate waiting. And it's with that I have my theme for you. Hey, everybody, this is RC Peck, and this is my weekend podcast. I am in Boulder, Colorado. It is 27 degrees outside. I hijacked a conference room in their library, which both the conference room and the library is beautiful. So I'm an outside observer, observing Boulderites and noticing what is different about them than people in Silicon Valley. A lot more facial hair, for one thing. And the theme for this weekend's podcast is the waiting game and how hard it is to wait. And so this podcast has two parts for you. One part, which is the first part, is 4 charts that define 2015 and that I think will define the last 2 charts I show you, which are about 2016. So what we should be watching, what we should be observing. And the reason I'm calling this podcast or the theme is the waiting game is because we are in a sideways channel for the market. And whether you're talking about the bond market or the stock market, both of them are sideways, and I'll talk about that a little bit more. So the first of my 4 charts for 2015, the first one is, I just found this really interesting. This is a price chart going back to 2010, so not a huge amount of data, 5 years of data, but this is just the year-over-year growth of the earnings per share of the S&P 500. And what I thought was most interesting was down here, all of 2015, 2014, the earnings, they're down. Now, it's flattish right here, right? So, but the earnings have fallen, and then we had a flat, let's call that 5 quarters of flatness for it being down. And what I find interesting is the market has to digest this. And in fact, the market saw this as kind of positive because I'm talking about the 2015 market, because the market was flat for the year, yet earnings took a big hit in 2014 and the market just kind of shrugged it off. So I thought that was really interesting. And I think watching earnings going forward, you don't need to, but if you want, just to see what they're doing, because we had 5 quarters of basically flat. Now, it says negative 14 to negative 15 down here, but basically the hit was taken at the end of 2014 and earnings are flat, and so was the market. So it'll be interesting to see what happens with earnings in 2016 with the market. The second of the 4 charts of 2015 was the balance sheets of 3 of the largest central banks on the planet. You have the Fed in the red, and if you notice here, the Fed's balance sheet has been flat for about 5 quarters too. And the market's been flat for 5 quarters also. And then you got this crazy green line coming up with the Japanese wanting to print everything, devalue their currency by 40%. In fact, the Bank of Japan is buying half of all Japanese-focused ETFs. The Japanese central bank is buying 50% of all those shares, which is incredible. And then down here, this chartreuse colored line is the European Central Bank, and they've started doing some printing, nothing too big, but you can see from 2012, or if you're listening, the balance sheet of the European Central Bank fell in 2013, fell in 2014, and just started at the very end of 2014 turning up again. So if the market is going to move higher in 2016, it's my humble opinion that the European Central Bank is going to have to really pick up the pace and do a lot more printing. I do not think the Fed is going to do more printing, but I think it's the European Central Bank's turn to do the printing, and that's been my view for the past 6 quarters plus. The third chart that I think defines 2015 is oil. Now, the thing that's interesting about oil took the huge immediate hit in 2014 when it fell from an intraday high of $110 down to about, which is incredible, it dropped to about $50. And then in 2015, oil was very volatile, but stayed underneath its 200-day moving average. This is the longest streak ever of West Texas Intermediate Crude, WTIC, being below its 200-day moving average. In fact, it's been below its 200-day moving average about 350 trading days. That's never, ever happened before. So this is interesting, and that really defined 2015 because there's a lot of high-yielding or low-quality corporate debt behind the price of oil. And with West Texas Intermediate Crude right around the $33 a barrel mark, it's going to really define a lot. Well, it defined 2015, and it's going to define 2016 also. And then the last chart I have for you for the 2015 kind of year in review is the VIX, or the volatility index, and how people acted in 2015. And I want to point out something very specific about the VIX. So basically the VIX it charts what people are willing to pay for call options and put options. And the more they're willing to pay for a put option, the more volatile the market gets, and the higher this line goes on this price chart. So what was interesting to me is if you can see the chart, the VIX popped up above 50. Now, what created a 50 print? Was it the September 11th, 2001, which was the first time I saw a 50 print? That was the September 11th. No, it wasn't that. Was it the finishing of the dot-com crash, a fall of 50%? No, that was above 50%. Was it the Lehman Brothers collapse bankruptcy? No, that wasn't it. Was it the total 58% fall in the 2008-2009 crash? Nope, that wasn't it. It was 12% correction. It was let's call it a 12.5% correction. A 12.5% correction shot the VIX up over 50. And we're comparing that to an almost certain market collapse in 2008, 2009, the largest bankruptcy in U.S. history, Lehman Brothers. Bear Stearns went out of business too in 2008. You saw the end of the dot-com crash. So its competition is pretty amazing. And all that happened in 2012 was the market fell 12.5%. Obviously scary, I get that. But to be in the same crowd of those other major world events tells me that people are super, super, super concerned about the money they have in the stock market. People are very concerned right now after almost 7 years of the stock market going up. People are super concerned right now. And I think that is actually the biggest takeaway. That is probably the biggest takeaway from 2015, that people are just super, super concerned with the money that they have in the stock market. And they were hurt badly in 2008. They were hurt badly in 2000 to 2002. And they're just so, so worried that it's going to happen again. And I talked about this theme. I started talking about this theme in 2009. In 2010, I said volatility is here to stay. And we're always going to see an increased volatility when when long-term economic cycles, which is one of my strategies, when LTEC is in a contracting mode, and LTEC has been in a contracting mode since the year 2000. We will see this increased volatility. So that's the biggest takeaway. Now here's the thing. What did this all mean for the stock market and the bond market? And so I want to show you that with my last two price charts. So here's the second to last price chart. This is the S&P 500 going back about 17 months. And everything I showed you, the VIX popping, oil dropping, I didn't mean that to rhyme, the level of concern, junk bonds crashing, earnings per shares down 16% and staying low. All that's happened is the market, the S&P 500, it just stayed in a nice 13% channel. Now the rest of the world's kind of crashing. Emerging markets fell hard, international markets fell hard. So other markets have fallen hard. It's this one market on the planet, and I'm just looking at the S&P 500, this $19 trillion index, that it's just kind of going sideways. Now, this sideways is very scary. It started with a drop in September, October of 2014. Here's the big drop in August where it fell 12%. We're now down about 5 or 6% off the lifetime highs. So yes, sideways is scary. I totally get that because it's very uncertain. So I could have called this podcast Uncertainty. But I really think we're in a waiting game. We have to wait to see what the market does. And then my last price chart I'm going to show you is U.S. long-term bonds. And look at this. This has just been, it's just been getting tighter and tighter and tighter over the last 12, let's call it 16 months. I mean, it is just getting tighter and tighter. Now, this happened before, but look, this is not going to continue getting tighter for the next 12 months or 18 months. This is going to break out in a direction. And if it breaks out going higher, that means the price is going higher, and that means the yields fall. Typically, when it breaks out higher, well, not typically, but when the price goes higher, that means people are buying more of long-term U.S. government bonds. If it falls, that means people are selling. If we see China selling some of their $2 trillion worth, we could see this fall even if the market falls. So we no longer have this if stock prices go up, bond prices go down. We're in a very different environment than we've been in a long time. And I'll stay on it. I'll keep watching it. But the theme kind of right now is we watch these two price charts. We watch the S&P 500, and we, as long as it stays within those two big, thick, red horizontal lines, there's not a lot to report. It's when they break out, and it will break out of one of them. A 13% channel for a $19 trillion index is pretty tight. So the takeaway is this. The S&P 500 is digesting a lot of information. It's looking into the future, 3 months, 6 months, 9 months, 12 months, and it's looking and saying, hey, what do we have in front of us? Do we have one more good year, 1.5 more good years? Yeah, and then we do our final 30 to 50% correction, total prediction on my hand. Or does it look into the future and go, you know what? We're going for that 30 to 50% correction. That's what we got in front of us, and we're going to start it now. The thing is, I get that humans hate, quote unquote, doing nothing, but we are doing something. We're waiting for that move. And if you follow the market probability strategy, you know exactly what we're doing. We're waiting. We're in great position for this, and we'll just wait for the next move to happen. Thank you, everyone, for being in my world. This is just another step in helping you protect your future and protect your portfolio. Until next time, this is RC Peck.